I'm Professor Ravi Sekar. Let's look at accounting for group structures. In this topic, we will look at three aspects: what is meant by business combination, what should be done in preparing consolidation at the date of acquisition, and you're consolidating at the date of acquisition. So, what is meant by business combination? When acquire invest in a company, the investment, the proportion of investment can vary. If it is less than 20%, we call that an investment, and the person who is investing is called an investor. The investment is recorded at cost, and later it is updated to fair value. If the acquirer's investment in a company is between 20% and 50%, the acquired company is called an associate. To find the value of investment in the associate, we use equity accounting. If the acquirer's investment is jointly shared, if there are two investors, an acquirer is one of them and has a proportion of 50% investment, it's called a joint venture, and the acquirer is called the joint venturer. To find the value of the acquirer's investment, we use joint venture accounting. If the acquirer's investment is greater than 50% in ownership, the acquired entity is called a subsidiary. To find the acquirer's investment in subsidiary, we use consolidation. Our attention in business combination is where the acquirer acquires another entity called subsidiary, and the acquirer's investment is such that he gains control over the subsidiary's operating and financial decisions. It could be achieved with greater than 50% ownership, but it's not necessary to have 50% ownership, could be even less. And in such instances, we apply a method called consolidation to find the acquirer's value of investment in the subsidiary. So A Limited has shareholders, and on behalf of A Limited, it acquires the shares held by B Limited, or the owners of B Limited. It acquires the shares for cash. When that happens, the A Limited shareholders are represented in the B Limited company. So which means effectively A Limited has the same ownership as B Limited, and as a result of that, A Limited can control B Limited through operating and financial decisions. More than 50% ownership of acquirer acquiring the acquiree or the subsidiary is the benchmark, but it is not necessary to obtain control of the subsidiary. There could be various other ways it can acquire control. There could be a contract or agreement between the parent and the subsidiary, or size of voting power of the acquirer, and the dispersion of other shareholders and apathy among shareholders can facilitate acquirer having less than 50% ownership but gaining control over the acquired entity or the subsidiary. The potential voting rights enjoyed by the acquirer, or we can call it the parent entity, also matters. AASB 10 defines control as requiring three elements: power, exposure to variable returns, and investors' ability to use power to affect its amount of variable returns. The power arises from rights, and we must show that the acquirer have the capacity to exercise power over the acquired. Exposure to variable financial returns is where financial returns from the acquired entity can be varied by the acquirer or the parent entity in the subsidiary. And third is investors' ability to use power to affect its amount of variable return, and this power that the parent or the acquiring entity can be exercised to vary financial returns in the acquired entity or the subsidiary. It can exercise those powers by using decision making over operating and financial decisions of the subsidiary. So the acquisition is where the parent shareholders or the owners acquiring a subsidiary and gaining control over the decisions in the subsidiary. And these decisions are operating and financial decisions, and then the parent making decisions about the financial and operating policies of the subsidiary. So what we have is a parent entity called Company A and a subsidiary called Company B. Parent controls subsidiary, and when we prepare group accounts, we consider A and B as a combined entity. That's called an economic entity. But A and B are separate legal entities. Economic entity, in some way, it's not a legal entity. By the word economic entity, it's a group entity, and the accounts are usually prepared on Excel. It does not have a dedicated financial system because it's not a legal entity and it's not required to maintain a dedicated financial system of accounts. When parent acquires a subsidiary, it can acquire all interests in the subsidiary, all ownership interests in the subsidiary. Sometimes it may not acquire all such interests, and there could be some shareholders in the subsidiary who doesn't want to sell their shares to the parent. And those shareholders are called non-controlling shareholders. But the question is, are they part of the economic entity or the group? So here's an example. A Limited acquires a B Limited ownership interest, 80% of Previous shareholders have sold their shares to A Limited, so A Limited now has 80% ownership interest, but 20% of ownership interest still lies with the B Limited or shareholders who are not A Limited shareholders. In consolidating the two entity, combining the two entity, there are three approaches that we can use. It's called parent entity, proprietary entity, and entity concept. They differ as to how non-controlling shareholders are treated in a combined entity. Parent concept says that non-controlling interest is a liability. Proprietary concept says non-controlling interest should be disregarded. Entity concept says that non-controlling interest is liability. In consolidation accounting, we use the entity concept where the non-controlling interest is treated as part of it. There can be direct control or indirect control. For example, A, the parent, is controlling the subsidiary B, 80% of it, and subsidiary B is controlling sub-subsidiary C, 100%. So A, by virtue, is controlling B, and B controlling C, A is indirectly controlling C. So let's look at what should be done in preparing consolidation at the date of acquisition. The first thing is that the parent invests some money, ownership, interest in the subsidiary, and subsidiary previous shareholders have sold their shares to the parent. And when parent bought those interests in the subsidiary, it bought the market value of the subsidiary. So what it means is it bought virtually through the ownership the fair value of net identifiable assets. That includes contingent liabilities, which is not shown on the balance sheet because it's a business decision. When such acquisitions are made, the buyer will consider not only liabilities shown on the balance sheet but also contingent liabilities that can materialize as liabilities in the future. And in addition to identifiable net assets, the parent can pay for unidentifiable assets such as goodwill or internally generated intangibles. Going forward, we assume that the income tax rate is 30% and the group does not pay income tax and the legal entities pay income tax separately. So what we need to acknowledge here is that the group or the economic entity is not a legal entity, it's an economic entity. This means at every reporting period, all consolidation entries must be recorded. In an accounting system, the general entries are recorded and it's not necessary to repeat them. But when it comes to consolidation, because we do it on Excel, all consolidation entries relating to a consolidation, even if they have been done in previous periods, must be repeated and must be recorded if they are relevant to the current period of consolidation. So we have the parent and the subsidiary, and we combine the two entities, and any transactions between the two entities becomes invalid because we are treating the two entities as a combined entity. So therefore, the boundaries that we have drawn for the legal entities disappear in group accounting. So here's what we typically do. We download the trial balance of parent entity onto Excel, download the trial balance of subsidiary entity to Excel, and then we do the consolidation journal entries as debits and credits as two columns and enter them, and then we add them across the row to find the balances in the economic entity. So here the deferred tax asset, deferred tax liability, there's a consolidation adjustment of credit that increase the economic entity balance. For the assets, there's a consolidation adjustment of credit that decreases the asset balance. So when preparing consolidation, there are three steps to follow. First one, ensure that all subsidiaries assets and liabilities are measured at fair value. Second, eliminate the fair value of equity in the subsidiary against the parent's investment because they are like transactions between the two entities and we now have a combined entity. 3. Look whether parent entity paid more than the fair value of net identifiable assets in this subsidiary. And if it is so, then we can find that there is goodwill, an asset that emerges as a result of the business combination, which was not apparent previously in the individual legal entities. There's also a possibility that the parent pays less money than the identifiable net assets. If that happens, then there's a gain on the purchase or gain on bargain purchase, and that gain on bargain purchase is an income that must be recognized on group financial statements immediately at the time the acquisition occurred. So goodwill is future economic benefits arising from assets that are not capable of being individually identified and separately recognized. So it requires the acquirer shall, at the date of acquisition, recognize goodwill acquired in a business combination, and then it should be maintained at its cost, and it should be measured using the fair value of assets, the subsidiary, against the investment to find whether there had been an excess paid over the fair value of identifiable assets and liabilities to see whether there's an unidentifiable asset that arises. So we can determine the goodwill on acquisition date. So let's look at how we consolidate parent and subsidiary at the date of acquisition. So here's John and Sarah's company. John has an equity of 3,000 represented by cash 1,000 and other assets 2,000. And Sarah's company equity is 1,000 and assets are 1,000. John wants to acquire Sarah's company, so pays Sarah for the share ownership, and John become the owner of Sarah's company. So effectively, by investing and owning the shares, what John has done is acquiring the net assets of Sarah's company. But John is not liquidating Sarah's company but running that company as a separate company. So when it comes to business combination, John's original company is a parent company, and the acquired company by John is becomes the subsidiary. So in business combination, now that they are a combined company, combined entity, investment and equity that John bought becomes an intergroup transaction, and that must be reversed. So when we get rid of that, the $1,000 of ownership represents net assets of Sarah's company, and that emerges. So by eliminating investment $1,000 against John's equity acquired at market value of 1,000, by crediting investment and debiting equity, we get John's net assets in the parent company of 2,000 and the fair value of net assets in Sarah's company 1,000, and then it is represented by John's equity, which is 3,000. If you look at the general journal entries, what John did was, as a parent company, credit cash, debit investment in Sarah. In Sarah, subsidiary company, what she did was credit equity in Sarah and debit cash. These are general journal entries. We can combine the general journal entries for analysis, and the cash and cash cancel out, debit investment in Sarah and credit equity in Sarah. So we say that this entry is invalidatory, we must reverse it for consolidation purpose, and the consolidation entry becomes credit. It's credit investment in Sarah 1,000, debit equity in Sarah 1,000. So here's the consolidation journal entry. Debit equity in Sarah 1,000, credit investment in Sarah 1,000.